Hey everyone, and welcome back. Today we're going to do something really interesting. We're going to tear apart a detailed blueprint for generating high-yield passive income, specifically looking ahead to 2026. Now this isn't just about picking a few winners, it's about understanding the entire architecture of a plan, one that's built for both big income and real stability. Okay, let's jump right in.
So, every journey has a starting point, right? And this is ours. This is a snapshot of the source portfolio from late 2025. Now, at first glance, it looks pretty great, kicking off a yield of around 12.5%. But lean in a little closer. You've got HDIV, which is a multi-sector fund, sitting at a hefty 15% of the entire portfolio. Then there's HBTE, a really volatile tech fund that's all in on things like AI and blockchain, making up another 10%. And right away, you can spot the classic problem here: concentration risk. It's that old saying about having way too many eggs in one basket. If just one or two of these top dogs have a bad year, they could drag the whole portfolio down with them. And that is the core problem this 2026 blueprint is designed to fix.
Okay, before we go another step, we've got to do the mandatory but super important disclaimer. What we're breaking down today is for educational purposes, period. This is an analysis of one specific strategy we've sourced. It is not financial advice for you. Everyone's situation is completely different, so please, always talk to a qualified professional before you make any big money decisions. All right, with that said, let's get back to it.
Here's our roadmap for today. First, we're going to dig into that hidden risk we just talked about. Then, we'll pull the curtain back on the 2026 rebalancing blueprint made to solve it. After that, we'll get into the philosophy of it all, the 5 core principles driving the strategy. Then we'll get into the nitty-gritty, the sectors and tactics they're using. And finally, we'll wrap it all up by talking about how you can take these ideas and start building a plan of your own. Sound good? Let's go. All right, Section 1, a portfolio's hidden risk. We're really looking at the current setup as a problem that needs a smart solution. It's not that the portfolio's bad, it's about making it stronger, more resilient for whatever's coming next.
In this slide, wow, it just lays out the whole shift in thinking perfectly. Check out the yield. The goal isn't to crank it up even higher, it's actually just to maintain it, maybe even accepting a slightly lower yield. Now, why on earth would you do that? Well, look at the trade-off. It's huge. You're moving from high concentration risk to reinforced stability. You're going from major volatility exposure to what the source calls sleep tranquil investing. And I mean, isn't that the dream? To engineer a portfolio that actually lets you rest easy at night?
And here it is, straight from the horse's mouth. This quote just hits the nail on the head. The portfolio is too heavy at the top, therefore too risky and concentrated. This one sentence is the entire reason for creating the 2026 blueprint. It's an admission that, yeah, the returns are great, but the structure itself is carrying a level of risk that's just not acceptable anymore.
Okay, so we know the problem. Now let's get to the solution. Section 2, the 2026 rebalancing blueprint. And this isn't just wishful thinking, it's presented as a carefully engineered model designed to systematically dial down that top-heavy risk.
And here it is, the after picture. This is the model for the 2026 portfolio. You can see the difference right away. HDIV, which was at 15%, gets trimmed down to a much more reasonable 10%. And look at HBTE, that volatile tech fund. Whoa, it's been cut in half, from 10% all the way down to 5%. And that freed up capital gets put to work, bringing other key holdings like the tech fund HTA and the European bank fund EBNK up to that core 5% level. The result? A much flatter, much more balanced foundation at the top.
This chart just makes that strategic shift so visually clear, doesn't it? On the left, you see that big cut to HBTE. The crucial point here is that this isn't just about selling something off. No, it's a deliberate rebalancing act. It's about reducing exposure to one specific kind of risk, in this case, a handful of high-flying tech stocks, while beefing up your allocation to other areas to build a broader, more stable portfolio.
So we've seen the what, but now it's time to understand the why. Section 3 is all about the 5 core investment principles. You know, any good plan needs a solid philosophy, and this one is no different. These are the rules that guide every single decision.
Okay, rule number 1. The absolute bedrock of this entire philosophy is capital preservation first. Before you even think about making money, you think about not losing the money you already have. This means the strategy is totally okay with getting smaller gains when the market is roaring, because the trade-off is much better protection when the market eventually turns south. It's a defense-first mindset for sure.
But don't think it's all about playing defense. No way.
Principle 2 is growth with resilience, and the goal is pretty ambitious, an annual total return of around 20%. But here's the kicker, the really important detail. That return is expected to come mostly from monthly income, not from the stock prices just going up. It's a structure designed to churn out a consistent, scalable income stream month after month.
And then we have this awesome checklist of guiding ideas. First, reinvest everything to let that compounding magic really take over. Second, don't even try to time the market, just adapt and rebalance as you go. Third, and I love this term, avoid worsification. That's when you diversify so much you actually make things worse. The sweet spot here is about 15 to 20 positions. Next, always focus on the total return, not just some flashy yield number. And finally, stay in the game and act with conviction.
All right, let's get practical. Section 4, Key Sectors and Tactics for 2026. This is where we shift from the big ideas to the actual tools and assets used to build this portfolio. This is the nitty-gritty.
The whole portfolio is basically built on these 5 main pillars. First up is technology, but accessed in a very specific way, using covered calls. Second, the stability of Canadian financials. Third, getting broad exposure through multi-sector and index funds. Fourth is something a little different, business development companies or BDCs. And fifth, looking beyond our own backyard with international investments. Let's break them down.
So let's look at that first pillar, tech. The thinking here is that tech isn't just some speculative growth sector anymore. It's basically a modern utility. This strategy uses covered call ETFs to squeeze high monthly income out of these tech stocks. Now, a quick breakdown. A covered call ETF is basically selling off the potential for explosive gains in exchange for getting paid cash right now. So yeah, you might miss a rocket ship now and then, but you get a much more consistent high-yield income stream. And for an income strategy, that's perfect.
Pillar number 2 is good old Canadian financials. And why? Well, you can pretty much sum it up in one word, stability. They have a long history of being stable, they're strongly regulated, and they consistently pay out dividends. They're seen as a reliable anchor for the whole portfolio, and the goal is to have about 10% allocated here.
Now for the last 3 pillars. Pillar 3, multi-sector funds like HDIV. They're great because they give you diversified income from a whole bunch of different places, all in one neat package. Pillar 4 is BDCs. Now these are interesting. They basically give you exposure to private credit. They lend money to medium-sized companies that you can't buy on the stock market. This gives you a totally different kind of return. And finally, Pillar 5, which is all about going international with funds like EBNK for European banks. It's about not putting all your geographic eggs in one basket.
And it's not just those 5 pillars. There are also smaller, tactical plays in things like healthcare and energy. But the most important part of this slide by far is that last point. 10 to 20% of the portfolio is left open on purpose. This is dry powder. It's a cash reserve for new ideas and opportunities that you know are going to pop up in 2026. Because a static plan is a fragile plan.
Okay, wow. We have just completely taken this blueprint apart. We've seen the problem, the solution, the philosophy, and the tools, which of course leads us to the biggest question of all. How can you take these concepts and apply them to your own life?
And that brings us to our final section, building your own plan. Now, the goal here is absolutely not to just copy and paste this portfolio. It's to understand the thinking behind it so you can translate these concepts into a strategy that actually works for you.
So before you go running off to build your own version of this, here are the final checks you absolutely have to make. First, and this is the most important one, you have to match the strategy to your age and your goals. Second, squeeze every last drop out of your tax-advantaged accounts, your TFSA, your RSSP, your 401k, your Roth IRA. Using these accounts is like getting a free boost on your returns. Third, think about your currency needs. And finally, pick a brokerage that actually fits what you need.
And this might be one of the most important takeaways from this whole thing. A financial plan is not something you carve in stone and forget about. It has to be a living, breathing thing. It has to be adaptable. The market will have its ups and downs. The key is to stay true to your core philosophy, like capital preservation, but be flexible enough to change your tactics as the world changes. Your plan at the start of 2026 should look a little different by the end of 2026. And that's not failure. That's just smart. We're going to end on this final, powerful thought from the source material. A portfolio that fits our lifestyle, not yours. Do your own research. And really, that's what it all comes down to. The goal isn't to find the world's most perfect portfolio. It's to build the one that is perfect for you, your goals, your timeline, and your peace of mind. Thanks so much for joining us for this deep dive.